As you define your trading strategies, the focus now shifts to establishing your market entry and exit points. In many cases, the timing of your position entries and exits will be the most stressful and thought-over parts of the entire trade. It is extremely important to establish clear entry and exit criteria and stick to those rules, because it is far too easy to base a decision on an emotional response rather than a strategy. Be definitive in identifying all the trading strategy elements you plan to use. You might also find it helpful to cite specific examples of trades you will or will not make based on a particular strategy. Market indicators are your trading inputs. For example, you might use charts to track certain market trends and only enter a trade when particular patterns have emerged. Or you might use a series of technical indicators related to momentum, moving averages, and trend lines. When exiting a position, you might establish profit and loss limits to stick to as the position develops. Write down the exact conditions that must be met before you can enter or exit a particular trade. Setups are the conditions you think provide a high probability of success. It can be useful to have a clear idea of the setup on which you like to trade, such as higher highs, lower lows, or moving averages. Trigger points define the precise moment you want to trade, such as markets moving through a new high or low. Managing open trades refers to the aspect of the trading plan that helps you deal with the emotions of holding open positions. Emotional responses to losing or winning are real and difficult to manage in the heat of the moment. In these emotionally charged situations, it is essential to have a strategy in place you can use to help quantitatively make decisions. Before you enter a trade, you should know where you plan to exit, and there are at least two for every trade. The first is your stop loss. If the trade goes against you, it should be written down. Mental stops don't count. The second is your profit margin. Once you get there, sell a portion of your position and adjust the stop loss on the rest of your position. As discussed before, never risk more than a set percentage of your portfolio on any trade. Professional traders play defense first because they know exit points are far more important than entries. And they also know a defined trading strategy helps when emotions run high.